Let's now talk market fundamentals in our segment Street View at Lunch. Joining us right now, Sandeep J Shah, Associate Director at Motilal Oswal Private Wealth. Sandeep, hi, afternoon. Good to have you on the show. Firstly, a word in the markets. Does it seem like this is the start of a big bull rally, or do you think for the year we are almost done around 7,500 plus levels?
Well, I think if you take a historical backdrop, we saw from 88 to 92 the market go up 10 times. From 92 to 98 the market did nothing. Then we had a tech bull market. Again 2000, 2003 the market did nothing. Again 2003 to 2007, 8 market went up 7 times. 2007 to 2013 again the market did close to nothing. So I think given what we're seeing in terms of the political change, I think we could be on the threshold of a multi-year bull market, and we could see stocks gaining in terms of multiples and the indices as well before this bull market is over. Of course, there will be roadblocks along the way. There will be sharp corrections along the way. There will be unanticipated corrections along the way. But if this government and whatever they've done so far in the first few days, including the amazing coup on the very first day of inviting the entire SAARC countries, I think if some of the actions that they've already started doing, if these are going to bear fruit, then there's no reason to believe why we can't be on the threshold of a multi-year bull market. The reason why the indices have not done much since the election results is because some of the stocks earnings, some of the large cap PE ratios have already expanded, and the market is actually waiting for confirmation that earnings will grow before these stocks rally again.
Sandeep, one of the highlight of the rally now is of course the way it is getting broadened by each passing day. Today of course 2:1 is the kind of breadth we are talking about. What is your view on auto ancillaries as a space, because that area is getting very active, witnessing institutional flows now. 20% up is what Amtech Group is today because of a Nomura upgrade. We've seen how Motherson and Bharat Forge have rallied. Any view on this space?
Yeah, in general, to begin with, the mother industry, which is autos, we are bullish on autos. And I think in auto ancillaries, without taking names, I think we have some exceptionally strong and large companies. Some of them have been doing very well, and some of them have a lot of potential as well. So when you see when you're hoping that the auto sector itself will revive, that will mean increased volume growth as well as some pricing power for auto ancillaries, and also the fact that some of our larger ancillaries are also plays on global growth, and given the fact that US economic growth has revived, China is still holding up, perhaps Europe is weakening a bit, but even Japan has been holding up. In this context, where global growth is positive and the hopes of economic growth reviving in India, we are quite bullish on the auto ancillary sector as well as autos.
What's the view then on realty, Sandeep? Would you advise investors to stay away from it or make use of the beta rally that we're seeing in place?
Well, I think there are two kinds of plays on the economy in terms of the beaten down sectors. One is which are driven by regulations, where you would put power, capital goods, infrastructure to some extent, and there are others, for example, like consumer discretionaries or housing, property, cement, and some of the other sectors. So which are also, some of them are interest rate sensitives as well. I think very broadly, I think one would like to actually have some exposure in this sector. This may not be the time to go overboard. Some of these stocks, as you rightly mentioned, have rallied, but to the extent that we have economic growth, you should see not just in housing but also on the construction side a pickup, and to that extent I think some exposure to this sector is warranted, but I think you've got to be very careful about the companies you select here, because corporate governance does tend to be an issue in this sector. However, there are some exceptionally good companies which come from very strong corporate groups with a very strong track record of integrity and corporate governance. So I think investors would perhaps be well advised to actually have some exposure in some of the quality names in the sector.
Sandeep, let's talk about the banking space then. If you look at the composition of the banking index, the private sector ones are trading anywhere between 2 to 3 times price to book adjusted 1 year forward, whereas the PSU pack is still between half time to say 1.2 time. Which end of this banking space would you be bullish on?
Well, we like both the private banks as well as the public sector banks. Obviously, the private sector banks are stocks you want to hold across bull and bear markets. In fact, in 2003 to 2008, one of the sectors which outperformed dramatically was banks. In fact, banks did well. The large private sector banks did even well from 2008 to 2014 so far. But obviously, given the fact that some of these private sector banks have been doing quite well for some time, given the fact that there has been for the last 3-4 years, except recently, a dearth of good quality stocks to own, given that some of these large private sector banks are reasonably owned, the fact that some of them have already hit foreign ownership circuit levels, chances are that some of the PSU banks might underperform. But if you're a long-term investor who likes to stay invested across cycles, I think you should stay put with your private bank exposure. But I think clearly PSU bank exposure is something that also that one would be looking to build because a recovering economy can mean that a lot of the NPAs which have gone, one, not just an arrest in terms of an increase in NPAs, but also you could see some reversals where actually, because most of the lending that is done by banks which are NPAs are actually collateralized. There is a collateral underneath, and if the business itself revives, then some of these non-performing assets could also start performing, in which case you could see ROEs which have dipped to 6 to 10% go back substantially higher. If you recollect, a lot of the public sector banks used to have ROEs from 18 to 24%. Even if you don't get there, but we get close to that, you could still see a significant upward momentum in PSU banks. And of course, if you have, if the PSU bank holding structure comes into place, and if you have, and they get governed by the Companies Act and not, the current act, banks are allowed to issue differential voting right shares, in which case the government can continue to exercise control, but give a stake, which means you should take care of the capitalization needs of the PSU banks, and a lot of them are under need capitalization. So I think if some of these things pan out, then of course over the PSU banks could outperform the private sector banks. But that's not to say that private sector banks are not good investment candidates. They still are. But you could obviously see a lot more beta or alpha come from the PSU banks.
Right. Sandeep, what's the view on the oil and gas space? They've clearly hit a buying frenzy, and then there is talk of the government, bringing about some clarification on gas prices by, the beginning of next month. Do you like the space?
Yeah, well, clearly the oil and gas sector, we would obviously have to break it up into upstream and downstream. But of course, all of them are affected by the fact that there are under recoveries in diesel, kerosene, LPG, and so on. And at the same point of time, as you rightly mentioned, if the government were to actually free up gas prices, it would mean that, currently India is importing so much of oil and even gas and so on. So if we can actually incentivize domestic producers and give them market prices, then to that extent, if production can increase and some of these companies' profitability could also increase, and also the upstream companies are also hurt because of the under recoveries in the sector. They have to bear part of the brunt. So there could be a double whammy for them in terms of a freeing up of gas prices as well as under recoveries on the downstream products going away. But of course, a lot of these stocks have already rallied, so you may not wish to chase them. But I think on corrections, you could be looking to build positions there as well, because some of these are, some of these companies are almost quasi-monopolies. If you take, even the refiners, the three large refiners, between them command a significant amount of market share. So these kind of industries where you have oligopolistic or quasi-monopolistic kind of structures are areas where the environment becomes benign or positive, then those stocks could do well. But let's remember that there are still some, of course, some regulatory issues to be sorted out, so you can't really go overboard there.
Sandeep, past few trading sessions we are looking at various ends of the agri-based stock also becoming extremely active. Today, of course, it's the tea-based companies on talks that production would be lower. Earlier, we've seen some policy intervention for sugar, even fertilizers have been active. Have you started researching that end of the market or not yet?
No, well, as a house, we obviously do cover some of the sectors you've mentioned. But I think investors would be well advised to, manage their exposure to sectors which are regulated by the government, and sectors which are not regulated by the government but still are economy sensitive. So you don't want to go overboard. I'm sure, we still have concerns of an El Nino. The monsoons have been perhaps very marginally delayed. There could be an impact if that comes about. I'm not sure if we want to play sectors where just because of a shortfall in monsoons you suddenly see prices of that commodity go up. I mean, that's a fairly short-term view or a trading view. But on the longer-term view, I think this government will have to act on agri reforms. I think that's very critical because that's the only real way that you can handle food inflation is by increasing supply. And to that extent, some of the agro-based companies should do well. But I wouldn't be looking to build a position in one day. I would watch this space very closely, measure the action taken by the government, look at how the monsoon is progressing, and then build an exposure there. But there's really no rush to buy here.
Sandeep, so good chatting with you. Really appreciate you taking the time out and speaking with us. That's the review from Motilal Oswal. But quickly talk about some more market views. Here's a view then from Andrew Holland from Ambit Investment Advisors, who says that the Nifty may scale 7,700 levels on global liquidity. He's also expecting robust economic growth for the next 3 to 5 years on the back of a stable government.